Hey everyone, welcome back, or welcome for the first time, to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. I'm super excited to have you with us today. We are unpacking a really fascinating topic that, let's be honest, often trips up even seasoned finance professionals. We're talking about fair value hedges of firm commitments under Ind AS 109. Okay, let's just dive right in and make some sense of what can seem like a pretty complex accounting puzzle.
But before we get too far ahead of ourselves, let's just lay down some quick ground rules so we're all exactly on the same page. For this entire explainer, our functional currency and our presentation currency, they're both the Indian rupee. That means literally any other currency we mention is classified as a foreign currency. Oh, and our reporting period is the standard financial year, so starting April 1st and ending March 31st. Make sense? Awesome.
So here's our game plan for today. We're going to look at the firm commitment mismatch, see how to hedge a $100 commodity, find out how Ind AS 109 comes to the rescue, break down those fair value hedge mechanics, and finally show you how to expand your Ind AS knowledge.
All right, Section 1, the firm commitment mismatch. Let's uncover this reporting anomaly.
So the core question we're tackling today actually comes straight from the massive issue repository over at gapadvisors.com. And seriously, they have over 4,500 distinct issues and expert responses on Indian accounting standards and Indian GAAP over there. It's huge. Anyway, the querist here basically asked, why is the change in fair value recognized, even though the inventory purchase is unrecognized at the reporting date? It's a really fantastic question, right? It hits the nail right on the head of why this stuff gets so confusing.
Okay, let's look at the two conflicting forces we're dealing with if we don't use hedge accounting. On one side, you've got your forward contract. Normally, this derivative is measured at fair value through profit or loss. Simple enough. But on the flip side, you've got your firm commitment. Now, this is an executory contract, which basically means it's not actually recognized in profit or loss unless it becomes onerous. So think about it. If you enter a forward to hedge a firm commitment, standard rules will force you to recognize the wild fair value swings of the forward, but completely ignore the firm commitment itself. It's crazy, but without hedge accounting, these two things accidentally increase your reported exposure to foreign currency risks in the P&L instead of reducing it like you wanted. Your financial statements end up telling the users a story that totally misrepresents your actual risk management strategy.
Moving on to Section 2, hedging the $100 commodity. Let's ground this in a practical case study under Ind AS 2.
Imagine your company just entered into a binding purchase agreement to buy 100 kilograms of some commodity for $100. Now, because that price is in dollars, which, remember our ground rules, makes it a foreign currency, you're suddenly exposed to foreign exchange risk. So being the prudent finance professional you are, you immediately enter into a forward contract to buy dollars. You're trying to perfectly hedge that exact foreign currency risk exposure coming from your firm commitment. But here's where we hit that roadblock. That $100 purchase agreement, it's an executory contract. You haven't actually fully executed it yet. Because of that, under normal rules outside of hedge accounting, you literally just don't recognize it. So your balance sheet remains completely blind to the inventory. But at the exact same time, it's being forced to react to the fair value swings of the forward contract you bought to protect it. It's kind of a mess. Which brings us to Section 3, Ind AS 109 to the rescue. Let's see how to actually align your accounting with your real-world risk management. You see, the whole philosophy of the standard is laid out right there in paragraph 6.1.1. It explicitly says, the objective of hedge accounting is to represent, in the financial statements, the effect of an entity's risk management activities that use financial instruments to manage exposures from particular risks that could affect profit or loss. That is exactly the fix we need. It's literally designed to cure the exact mismatch we were just talking about, allowing your financials to convey the true purpose of your hedging. So how does this actually work in practice? Well, your company designates that forward contract as the hedging instrument and the firm commitment as the hedged item. And since you're using what we call a plain vanilla forward, where the critical terms line up perfectly, meaning we're buying exactly $100 for our $100 obligation, the hedge is considered highly effective on a qualitative assessment. By locking in that exchange rate, you've successfully limited your exposure to the changing fair value of your inventory. All right, Section 4, Fair Value Hedge Mechanics. Let's walk through the step-by-step solution. First up, we have to establish our definitions. We're officially designating this relationship as a fair value hedge. Why? Well, because an unrecognized firm commitment is a perfect fit for a hedged item under this specific category. So again, our forward contract is our hedging instrument, and that binding purchase agreement is our hedged item. Now, here is the really cool part.
How these 3 steps completely neutralize your P&L exposure. Step 1. Exactly like before, your forward contract is measured at fair value, and those changes go straight to your P&L. But watch Step 2. Thanks to hedge accounting, the change in the fair value of that unrecognized firm commitment is suddenly pulled onto the balance sheet and recognized as an asset or liability. Which leads us right to Step 3. That change in the firm commitment triggers a corresponding gain or loss in the P&L. So, if you suddenly have a massive gain on your forward contract, you will instantly recognize an identical loss on the firm commitment. They perfectly offset each other. Boom! Your net exposure to foreign currency risks in the P&L is completely saved.
And to tie a neat little bow on this whole thing, what actually happens when the inventory finally shows up? Well, paragraphs 6.5.8 and 6.5.9 of Ind AS 109 spell it out perfectly. The initial carrying amount of the asset, which is our inventory, gets adjusted. It includes that cumulative change in the fair value of the hedged item that we've been diligently tracking on the balance sheet. So those fair value changes in the firm commitment essentially bake right into your inventory cost. It is a perfect reflection of reality.
Finally, Section 5. Expand your Ind AS knowledge. Let's look at some essential resources for auditors and finance teams. By the way, I have to mention, this brilliant breakdown and the case study we just went through, it was actually featured in the 221st edition of the Gap Advisors Task Weekly newsletter. It was authored by CA Manish C. Iyer, director at Gap Advisors, and published over on LinkedIn. It is just an incredibly rich resource if you're dealing with this stuff.
Seriously, if you're an auditor, a finance professional, or a CA student, you really need to be leveraging these tools. First off, anyone can register for totally free at gapadvisors.com to submit issues on Ind AS and Indian GAAP. And the best part? You get incredibly detailed responses delivered right to your inbox. I mean, that is absolutely vital for auditors who need rock-solid, bulletproof documentation on how they handled the specific Ind AS application issue. Also, if you're on LinkedIn, go subscribe to the Task Weekly newsletter. Again, totally free, and they've got over 230 editions out already. Oh, and for really deep dives into issues exactly like the one we covered today, make sure to check out the Gap Advisors Ind AS Clinic podcast. You can find it right now on Spotify, Amazon, or YouTube.
Just a quick housekeeping note before we wrap up. Please keep in mind that the views expressed here are the personal views of the author and they aren't binding on the audience. We always recommend seeking out expert help before taking any action. Or, refraining from taking action based on the views we've discussed in this explainer. So, I'm going to leave you with one final thought to chew on. How are you going to thoroughly document your very next complex Ind AS application? I highly recommend leaning on the resources we talked about today to help you out with that. Anyway, thank you so much for your time and for hanging out with me for this explainer. If you found this breakdown helpful, please hit that like button, drop your thoughts down in the comments, and hit subscribe on the Gap Advisors Ind AS Clinic channel if you haven't already. And most importantly, please share this explainer with your contacts, your colleagues, your audit and finance teams, and any students you know pursuing their CA course. It really helps us spread this vital knowledge of Indian accounting standards. Keep learning, and I will catch you in the next explainer.